This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino, well-known author and publisher of the website dollarcollapse.com. Good morning, John, and welcome back to Macro Analytics.
Good morning, Gordon. Good to be back.
Well, I really enjoyed our first session. It's been a month already. I think we got some great subjects this week to talk about. But for our listeners that might have missed the first session, I asked John to join me on Macro Analytics in 2012 because three reasons. One, John has a firm grasp of the issues with the U.S. dollar and the growing emergence of currency wars, which we're witnessing and which we discussed last month. Two, his writings touch on a number of our 2012 themes identified in our 2012 thesis paper, Financial Repression. And three, John's website identifies on a daily basis important articles on the web in a manner that allows you to focus on what is important. And his site has categories that overlap surprisingly well with the emerging central issues our research is presently highlighting, which I thought really could help a lot of our listeners. The roadmap that you see on your screen identifying financial repression is part of our Thesis 2012 report, which is free on our site at GordonTLong.com. It shows financial repression is just another step contributing in the roadway to a potential fiat currency failure. By the way, a fiat failure, John, I believe you recognized in the cards probably, I'm guessing now, at least 10 years ago. Is that safe to say?
Well, James Turk and I published The Coming Collapse of the Dollar and How to Profit from It back in 2004. And at the time, we were worried that we weren't coming out with a book soon enough, that everything was going to fall apart before we could even get the thing published. So it seemed imminent back then. And it's the system has hung on longer than seemed possible at the time. But yeah, you know, it's been obvious that the system was headed for some kind of a collapse for a long time.
But when were you formulating in your mind, even writing the book?
I had written a book previous to that on the real estate bust. And at the time I was researching that book, my assumption was that we were basically a healthy system that was having rolling bubbles. Basically, one part of the financial system would get blown up like junk bonds or in real estate as it was happening, and then that bubble would pop and we would go on in a reasonably healthy way. But as I researched that book, it became obvious that the problems were systemic. They weren't specific to one sector or another, that the whole fiat currency system in the U.S. and the world in general was basically in the process of being destroyed. And so that changed my thinking dramatically. It made me a lot more pessimistic. In the early 2000s, I assumed that we would basically get our act together and go on and be a healthy system as far as the eye could see. And by 2003, after I'd got done researching the real estate book, it was obvious that we were headed for some kind of a collapse sooner rather than later. And that point of view really hasn't changed. We have delayed a systemic global collapse by taking on another $10 or $15 trillion of debt in the U.S. and an equal amount in the rest of the world. So all we've done is kick the can down the road, to use the phrase that's current right now. And we've set the stage for an even bigger collapse somewhere in the next decade. But we haven't done anything to help us avoid a collapse. So it's more certain now than it was back then, and it feels like it's getting closer all the time, although there's no way to know really when the system truly flakes out.
Nothing really changes. When I wrote all my papers on called Extend and Pretend, which was a whole series back in 2009, 2010, and as you just said, we now call Kick the Can Down the Road, and now we're migrating to something called Fake It Till We Make It. I think they're all the same thing, aren't they?
Well, yeah. I mean,
nothing's changing but the label.
Yeah, and it basically comes back to the fact that the world will still take dollars and euros and yen. And as long as people consider the main fiat currencies of the global financial system to be money and accept it as such, then we can keep extending things. You know, we can keep recapitalizing the banks, and we can run up big deficits and hand that money to people, and people will spend it. And so the system can kind of go on in a normal way on the surface, but under the surface, it's being more and more corrupted all the time. And so the acceptance of fiat currencies is really the key to the whole thing. As soon as the global financial system figures out that these pieces of paper or their electronic equivalents are basically worthless, and starts to shift from paper into real assets, you're going to see, the equivalent of a hyperinflation, where the prices of assets go up because the value of currencies go down. And that will be the kind of death spiral that we won't be able to pull out of when it happens, because our only main tool to keep it going is the ability to print more currency. When no one wants that currency anymore, everything falls apart. And that's the end game, and that's what's coming. And the only question now is timing and the catalyst. What pushes us over the edge?
I wrote a paper called Debt Saturation and the Illusion of Money. Think of it as you're talking about this misperception or misunderstanding, rather, of what money is, or at least what it was and what it is now, as we redefined it, for example, when we're coming off the gold standard and really into a true fiat-based system. But I had an excellent set of discussions with Ty Andros here a couple of weeks ago, and I encourage our listeners to go through some of those tapes. Did just an excellent job of really going through and defining money as a store of value and what it is no longer representative of. John, I need to cover off some mechanics here before we get going. We have slides to guide our conversation this morning, and I would ask our listeners to open the slides to full screen viewing. You need to open the slides to full screen viewing to properly see the detail we'll be discussing. There's an icon in the bottom right corner that by clicking it will do that. The slides will then automatically advance as we go along, which is something new that we didn't have previously. There's a box below the slides where you can make comments or ask questions. We're still testing this. It's working pretty well, and I'd encourage you to put in your questions from today's show so that the next time John's here, we can answer some of those questions. John, what I hope to do this morning is to discuss a speech which George Soros made at an Institute for New Economic Thinking, a conference in Berlin, about a week or so ago. Some of the leading macroeconomic minds in the world were there, and it isn't just academics, but what was so interesting is it's for people that are really outside the mainstream economic thinking that he brought in. And it's an institute that he had funded originally. Now it has its own funding to really foster mainstream thinking, out-of-the-box thinking. And I thought that what George Soros had to say was worthy of our discussion this morning because, I guess, 3 reasons. Few truly understand the European situation as well as he does, being both a European and having lived there the vast majority of his life. Maybe more importantly, he's a proven financial practitioner. He's not a politician, and he's not an academic. And third, he has no hidden agenda. Frankly, John, like you and I, we have this luxury of calling it out. We're not encumbered or obligated to anybody else. We're not stepping on anybody else's toes in doing that. I've distilled his talk and put it into some clear points and some simple bullet points here. Before I go through these, John, I know that you had some comments that you observed.
Yeah, he said some very provocative things about economics in general. He said basically that mainstream economics had failed miserably to predict the financial crisis because they have a fundamental misunderstanding of how economies work. And that's derived from the fact that economists have tried to be hard scientists in the last few decades, where they see the economy like a natural system that is always going to behave in a certain way under certain circumstances. So we have economic theories like rational expectations and efficient markets, where they try to treat people like molecules, but a chlorine atom or a molecule that makes up a substance will tend to behave in the same way under the same circumstances over and over again, but people aren't like that. So traditional economics breaks down when it tries to make predictions about complex systems like economies. And the two main economic schools of thought, monetarism and Keynesianism, both approach economies as physical systems. You adjust the money supply and the system will grow steadily, or you adjust aggregate demand and you'll get steady long-term growth. And neither one of them were able to predict what happened in the middle of the last decade, because people don't behave like atoms and molecules. And so George Soros has his own theory called reflexology that approaches economics in a way that allows the actors to have a say. We try to understand what's going on, and then we try to affect a system by betting on it. And in that way, we change the economy even as we try to understand it. And that's an interesting, provocative way of looking at the world, but I don't think it's necessary, because the Austrian School of Economics already got this. Instead of looking at the money supply or aggregate demand, the Austrians look at the changing balance sheet of an economy over time, and see that as a reflection of the changing mental state of the markets. And as balance sheets get more and more risky, the risk of a catastrophic collapse becomes greater and greater. And they predicted the collapse of 2007, 8, and 9, because they saw the global balance sheet changing in a dramatically unfavorable way. And so we can use that prism. We can use Austrian economics to predict what's going to happen in the future. And when you look at the world that way, it's catastrophic. We haven't fixed anything. We've actually made the global balance sheet a lot more risky and unstable in the last few years in our attempt to stave off a 1930s style depression. So the Austrians would say we're headed for an even bigger crash in the future. And I think that's the framework that we should use when we approach something like the Eurozone, which it was a subject of George Soros' talk, and about which he's very pessimistic.
Yeah, incredibly so. I agree with what you're saying, John. The Austrian school clearly got this right and had it right all along. But it wasn't that they were trying to call this. It was more just the whole of thinking and philosophy of Austrian economics, and which is not taught in school. It's something you have to pick up on your own. I originally, numbers of years ago, said I was a hard-nosed Austrian in my thinking. I think it's not that I've come off that. I've broadened it more, and probably because some of the reasons that George was alluding to in the social sciences, even though it's better supported, as you point out, by the Austrian school, because I know that the biggest flaws of generally most of the current schools are that, and as an engineer, this goes against my thinking, they're too mathematically framed. And as George said, the natural sciences versus the social sciences. And today I believe very strongly in the element of behavioral economics and the magnitude and the influence that it truly has. And that whole science that it integrates into something, the sciences of chaos theory, gives me a closer way of understanding what's going to happen. And I'm saying that now as a technician who does a lot of analytical studies, which some of our listeners listened to over the last week, where I'm right into the charts from a macroeconomic standpoint, and I can see the behavioral swings and how it influences decisions within the charts. John, what I have up here on this particular chart was really kind of the distillation of what he was saying, George was saying, specific to Europe, not overall, of what he saw the core problems, issues, and consequences being in the EU right now. And what I distilled from it was that he basically said that from a Euro experiment standpoint, the key was that the Maastricht Treaty was flawed, and it was flawed in the elements of design, and it was flawed in the elements of mistaken beliefs. And and I've laid out here what the design elements were. And I think most of these now, anybody who's paying much attention pretty well is aware of these. There was and maybe even before they were put together, Euro was put together, the EU was put together. They knew that it was not a monetary union you wouldn't have it without a political union, but they expected that given events, these things would allow it to happen. and that is a political union, etc. But I don't think from a design standpoint that money printing removal which meant the effective implementation of a hard currency regime was fully understood. And I think that came out when I was listening to George's talk. And by that meaning that the individual countries like Greece or Italy or Spain can't print their way out of the problem because it's held within the EU itself. So it basically de facto puts them into a hard currency. And there's been very, very few countries that have ever got into a situation like this without attempting to print their way out of it, which we're all trying to do at a global basis. And then these mistaken beliefs that he also said was a core, and each of these all led to unintended consequences. And the one that really resonated with me was the mistaken belief that the ECB treated government bonds as riskless assets that the banks could hold without allocating any capital reserves against them. And that is a significant problem that even today as we talk, what's going on in Spain is still reinforcing this whole thing, and that is how the country banks are borrowing from the ECB, buying sovereign debt, even though they know that Spain is got a high probability of a failure because they can put it on the banks as riskless. With clearly there is magnitude of a risk there. But did that summarize it to you, John, or was there anything I missed there that you thought were the elements of what he was the core of what he was arguing?
No, you got it, Gordon. I mean, the Eurozone was set up either without a lot of forethought or with exactly what is happening now in mind at the time as an excuse for political union. In other words, they saw if they understood what they were doing, and it's not clear that that's the case, but let's take that as an assumption to begin with here, and if they understood what they were setting up, then they knew that the system wouldn't be stable in its original form and would have to evolve into a political and economic union more along the lines of the United States, where, every state in the U.S. has the same Social Security and Medicare plan. In other words, our benefits programs are consistent across the states, and the richer states subsidize the poorer states, and we kind of sort of get by. In Europe, something like that will have to happen with basically Germany in charge. And it's conceivable that the guys who set up the euro originally saw this coming and expected Germany and France and one or two other of the more financially conservative, solid European countries to eventually become the political and economic leaders legally rather than just de facto. And so that's kind of what we're heading for now, because the system is basically in the process of collapsing, and there are really only two choices. You break up and let the weaker countries go their own way now, which would be, we could talk about that in a minute, why that's technically really hard, okay? There's a lot of pundits out there saying, well, yeah, Greece will just leave. It's not that easy.
John, you brought that out in spades in your article, that it's not a viable option right now.
Basically, let's say, for instance, that Greece decides it wants to leave the Eurozone. The pain is just too great, austerity and unemployment, et cetera, et cetera. They elect some new leaders who decide to leave. Well, the minute they make that announcement, everybody pulls their money out of Greek banks because they don't want their euros to be converted to drachmas at a 50% discount somewhere down the road. So you get an instant bank run, which closes down the entire Greek banking system on day one. And so Greece descends into an instant depression if that happens. And so that is not a good option for Greece. So the second choice would be for them to just announce it over the weekend, on Sunday night, say, oh, by the way, on Monday morning, all bank accounts are going to be converted to drachmas. And this would prevent a bank run in Greece, but it would cause a bank run in all the other likely prospects. Portugal and Spain would instantly see everybody pulling their money out of their banks on the assumption that they might be next. So you see all the Spanish bank accounts and all the Portuguese bank accounts flowing into Germany, which would shut down the banking systems of Spain and Portugal, which would then shut down the banking systems in Italy because they're the next in line, and you would see basically a continent-wide depression and a big bang dissolution of the Eurozone. Now, John,
just to interrupt you there. And as you well know, that is almost exactly what is happening right now. The deposits and all of the peripherals are plummeting. And,
yes.
and they've been accelerating. I've been tracking and writing about it for, 6-7 months now as the data became more available. What I saw the other day, and the numbers that the monies now flowing out of Spain are so significant that it's the monies coming in from the litro financing that's going in to subsidize, really effectively, the country banks' loss of deposits. It's almost 1-for-1.
Yeah, which makes a lot of sense. I mean, if you got a Spanish bank account, you'd be crazy not to cash it out and move it to a country that's not going to leave the Eurozone. Germany won't leave.
Both at the household level, which are doing it, the individuals, and maybe more importantly, because of the size, corporate investors.
Yes.
Institutional investors. So if you're any kind of money manager or if you're a manufacturer, you're not going to hold your operating cash there. You're going to put it in there on a daily basis, even if you still have facilities. So that's what's going on.
And it's not even really a choice because you have a fiduciary duty to your shareholders if you're a corporation. And that involves keeping your cash safe.
Can you imagine being a chief financial officer standing before the finance committee and explaining that you haven't pulled your capital out of the country?
Yeah.
You'd be fired.
Yeah.
Or you've got a detailed plan in place. And remember, John, as you well know, when we had the 2008 collapse really was in the September timeframe, what happened was with the money markets, we had a run on the bank because it was $5 trillion that basically, fundamentally, the bank run was. All the chief financial officers went to their screen when they thought money markets would break the buck, and they moved them into T-bonds. And there was so much money that moved that the Treasury felt they were hours away from a collapse because they couldn't stop it. And they subsequently came in with the Federal Reserve money market fund to guarantee it. But that's the point I was interjecting here is these bank runs are different than old bank runs. They happen with a click of a screen. They happen in corporate conference rooms. And that's the money that's leaving the country. And it's the money that's being pumped in from the ECB's litro right now that's saving the pig. So I echo your points. I'm just arguing that it's happening as we talk.
Yeah, it is. And the end game here to avoid a complete dissolution of the Eurozone is for Germany and France via the ECB to basically just take over all the debts of the insolvent Eurozone countries, just guarantee them across the board. And that'll stop a run on, Spanish or Italian banks, but at the cost of destroying the balance sheet of Germany and France and the ECB. These guys, they're reasonably solvent countries if we believe the official numbers, but they can't take on all of Italy's debt and all of Spain's debt and stay AAA credits. So their problem is what happens afterwards. Does the euro, which really depends for its value on the solvency of Germany and France, become a weak currency that is subject to a crisis where everybody wants to bail out of euros because they see Germany and France as no longer viable credits, and that's what we're looking at out there because it's not clear that the eurozone with Germany and France guaranteeing anybody else's debt is viable even when that happens. So it's completely possible that the only solution that these guys see right now, which is a fiscal and monetary union, still won't work. That the euro will be seen as such a weak currency at that point that we'll have a continent-wide run on the currency, and then who knows? Then all bets are off because there's no tool left. Once they can't print as many euros as it takes to guarantee everybody's debt, then it's not clear what happens.
When you're pointing out with Germany's reaction and what it means to them, that was one of the points that George Soros brought up, and I just have the screen up here now. He was concerned that one of the number of unintended consequences that he saw was in fact the Bundesbank's stance and what they're currently doing, both the tightening of credit in Germany and the worrying of the responsibility that it's effectively shouldering. Especially as this money is just flowing into Germany as considered the riskless trade right now.
Yeah, see, this isn't a good deal for Germany. as it goes on either, because they're taking on so many new debts and seeing so much money flow into the country, and that's at first blush that's kind of a good thing, but it's not if it goes on too far, because it still distorts economic decision making and will lead to a deflation in Germany. While it exports inflation to everybody else.
That's the issue, is that Germany's economy is in fact slowing because the biggest export partner that it has are the peripherals, where it's been exporting its goods, and the economy has been slowing so quickly in all across Europe, but specifically in the peripherals, that Germany is clearly now feeling it. And also the worry that the Germans have a percentage of the ECB, I believe it's 26%. So all of these debt and money, this ring around the rosy with money, at the end of the day, the German Bundesbank's sitting there holding the bag. In many ways, a giant check-kiting scheme that's going on here, but it keeps working until it doesn't. And then when it collapses suddenly, without warning.
That's a crucial point about Germany, that they've been able to put up these really good numbers in the last decade, basically by exporting to the peripheral countries who were borrowing money from German banks in order to buy stuff from German manufacturers.
That's exactly what the strategy was when it was formulated, John.
Yeah, and that's basically vendor financing. Companies do that.
We used to call it layaway when we used to buy suits back when I was a younger man. So you're vendor financing, and that's what Germany did very effectively in Frankfurt with the banking system, and it works. But what happens was, as I was a young man, but if I can't pay for that suit that's now worn out that was put away in financing, what happens? And it isn't that I have troubles. It's the store that had the trouble. In this case, it's the German banks. So you reach a point where the gig is up.
Yeah. So now Germany has to reverse out a lot of its great numbers from the previous decade. Its trade surpluses are going to be seen to be fictitious to an extent, and so maybe it really had, if you add up everything and take everything at its true value, they actually had a trade deficit, for the last few years, and their nice pristine balance sheet is suddenly going to be laden with a lot of the debt that their banks created when they lent money to Spain and Italy and Portugal and Greece. And that money's going to migrate back now to the Bundesbank or to the German government or to German banks, which will have to write it off. And so all of a sudden, Germany's numbers are not that good. They're not as strong an economy as we thought, because they have to deal with the debt that they took on or that they created, and which has turned out to be unpayable.
Having lived in Germany for a period of time, John, I was up close and personal with the industry, and I don't think people fully understand how dependent German economy is on a number of key industries. One, high-end automobiles, which means it takes growing and expanding economies with money and wealth to buy higher-end performance automobiles. Second, the amount of high-quality machinery that Germany's able to produce, and machinery that's used in the process of production, vis-a-vis for Chinese manufacturing used to be U.S., and slowing economies tend not to be rebuilding new pieces of machinery. And then third, the banking infrastructure and how dominant it is, which you're talking about. So all three of those right now have got tremendous strains on them. So any kind of shock to a major losses in the banking system, and I'm thinking about the Landesbanks here now, which are the real estate banks that somehow are being quietly covered over. In themselves, it's not just the Kajas in Spain with real estate. I really challenge some of them in Germany, which again have been taken over and nationalized, but are going to show their heads. I suspect after the next elections. It seems to me that it's after the elections we always learn about the problems, right? It's like probably next week we'll hear about the problems in France. Maybe give them a couple weeks, assuming Sarkozy's not reelected.
Well, the French election is a really interesting wild card here, because the guy who looks like he's likely to replace Sarkozy is a socialist whose platform calls for renegotiating all the treaties that imposed austerity on the peripheral countries in the Eurozone, and basically easy money, looser fiscal policy. So he's going to be in favor of aggressive inflation if he comes in and he gets what he wants. And so which is inevitable. I mean, that's the only course that's going to be left to these guys, but his election would be a reflection of that process, that inevitability. we're going to see people like that be put in charge just because voters are not going to put up with austerity. They're going to want to try something. And that something is going to be easy money, lower taxes, and aggressive expansion across the board, which is highly inflationary if it works. If it actually does offset the collapse of the debt that's going on right now, then we'll see a swing towards a much weaker euro, much higher rates of inflation, and basically the currency crisis that's looming out there at some point.
I wrote 2 years ago that I felt the sequence here was that people would demand austerity, and it was witnessed by, for example, a UK party came into power because they were going to implement austerity, and that was the big push. But as quickly as I was saying that that's what people would want, the moment that the policies actually began to be implemented, everybody would change that tune, because austerity is something you want to happen to somebody else. But the moment you're starting to see that it's going to impact you, you have a different view of it. And that's what's happening now because people are seeing it. So there's a wave of government changes that are going to happen as the existing parties are thrown out and the new parties coming in, which will be lighter on austerity, which means they're going to push back on all of the commitments that they've made through the EU, which itself is pushing the EU into a tenable position. And I think, matter of fact, John, you just wrote a paper that the biggest flaw in the EU was going to be elections, did you not?
Yeah, and it illustrates a crucial point about debt in general, which is for a country, when you borrow too much money, you become ungovernable. No matter who's in office is going to be unable to come up with a painless fix. And so they're going to instantly alienate voters. So, like you said, we see people come in who promise to balance the budget. But then as soon as they try to do that, that means taking money away from voters who kick them out of office in favor of guys who come in promising inflation. Well, okay, they start to inflate, but then that drives up the price of the cost of living. Everything that you need goes up in price faster than your income goes up, and you as a voter don't like that either. So you kick them out. So you get this seesaw of every election becoming a throw the bums out event, and nothing good happening because there is no painless solution. So eventually the debt has to be wiped out one way or another, and eventually it is wiped out because something that has to happen eventually does. But it happens chaotically. A pendulum swing back and forth between these two philosophies, neither of which work, until the system just falls apart. And then you get into Jim Rickards' currency wars scenario, when you have a lot of different countries trying to do the same thing at once, where they figure out that the only way to try to get out from under all this debt is to cheapen their currency to the point where where their debt is inflated away and where they have trade advantages over their trading partners, but everybody else is doing the same thing. So you get a kind of a currency death spiral, which is what we're heading for. The election in France will be a milestone in that process, but just one. There will be many more, and as it plays out, it's eventually going to be disastrous for these fiat currencies.
I think the market is going to react very badly to the French elections because it's a signal of what the future looks like, not in France, but in Europe, to echo the kinds of things it's going to be put in front of all of the investors' faces, what's in front of them. Because, we've seen it in Spain, we've seen it in the last set of elections, and this is going to question all of the funding, it's going to question all the commitments that have already been made, and there's going to be a question whether well, we'll see. We'll wait till the elections and what the results are. But right now, it does not look good for Sarkozy.
And you would think that the point at which this is felt would be the euro, the value of the euro in foreign exchange markets, because equities might actually do okay in Europe if they expect more government money flowing into asset prices. But on the foreign exchange markets, you'd expect people to be leery of holding euros if France, one of the main supposedly stable, trustworthy economies in the eurozone, is going to become inflationist. So it's possible that you see a dramatic drop in the value of the euro, at least versus real assets.
That's how I see it, John. Actually, is I see the issue not being the equities in Europe. I see it being the euro itself, and I see the euro itself moving towards 115, which is a fairly significant plummet, or even lower in longer term. As I've been watching it against the yen, and the yen cross right now, which is sending some signals. But what that means is it will probably be a flight to safety, and therefore the U.S. dollar goes up. And typically, strengthening U.S. dollar has been bad for the U.S. equity markets because you're denominating it in larger dollars. So there'll be a balance there, but that's what I'm seeing. John, we just got going here, and we're out of time, and so we're going to have to wrap it here for this session. Last point I'd like to make on George Soros's comments was I have the slide up. His prognosis overall was not good. Actually, quite skeptical. I mean, he says there's a lot of decisions and things that have to be taken, but the runway's getting pretty short, and there's not a lot of time in front of them to make key decisions, and especially based on what we just talked about. If the leaders themselves are going to be changing, what chances are they of really sorting out the difficult problems in front of us? Any last comments you'd like to make here as we close?
Yeah, on Europe, I think that we're moving into a potentially really unstable stage here, because you've got Spain and Italy finding it harder and harder to borrow money, while economic policy in France is up in the air. They're going to be paralyzed while this election is going on, and in the aftermath of the election, because it'll take a while for the new leader to get it in and get going and start implementing their policies. So it's possible that it's not easy to react in a constructive way for Europe to the financial markets not wanting any more Spanish and Italian debt. So you get the potential there for some sort of a crisis that the system isn't able to address. And that could be coming in the next month.
John, I thank you for joining me for this three-part series. I look forward to the questions our listeners send us. A reminder to our listeners to add your questions and comments directly below the slides before you sign off. And John, any closing comments on how our listeners might learn more about what you do and how to read your writings?
Well, I run dollarcollapse.com, which is a blog/news aggregation site that covers a lot of the stuff we talked about here, updated daily.
So we'll be back together in a couple days, and we'll pick it up then. Talk to you later.
Great. Talk to you then.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.